Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we are strapping in for a high-altitude financial investigation. We're doing a comparative analysis of aerospace component powerhouses. TransDigm Group, that's TDG, and Loar Holdings, ticker LOAR.
And this is just a classic, fascinating scenario. You've got the incumbent behemoth versus, the high-growth challenger. But the thing is, both companies share a fundamentally identical core DNA.
Right.
They are masters at monetizing proprietary aerospace intellectual property, mostly through these recurring, very high-margin aftermarket sales. I mean, this model just generates cash flow that few other industries can even touch.
Absolutely. So what's the mission today? We have to define the critical investment thesis here.
The central conflict, the thesis we're exploring, it really rests on whether LOR's rapid discipline consolidation and that remarkable 22.4% Q3 sales growth will allow it to effectively close the scale and margin gap with TDG.
Which is a giant that closed fiscal year 2025 with an astounding $8.831 billion in sales and a robust, almost unbelievable 53.9% EBITDA margin, all while TDG manages a planned CEO transition and a potentially margin-dilutive $757 million acquisition.
Yeah.
That perfectly frames the conversation. It's a tale of two playbooks executed at totally different velocities and scales.
Let's start where the money is biggest, with TDG, the undisputed incumbent. We really need to unpack what makes their financial structure not just successful, but, well, historically indomitable.
You used the right word there, indomitable. TDG's financial power is the absolute gold standard in this space. I mean, when you look at their history over 18 years as a public company, the outperformance is just staggering.
Really staggering.
TDG has outperformed the S&P 500 by 26 times, and their direct peer group by 12 times. Just think about that longevity.
It's incredible consistency.
And that track record has generated a stunning 36% internal rate of return for over 3 decades. It's returned nearly 3,300 times its initial invested equity. 3,300 times. That's not a stock. That's a generational wealth creator. When you see numbers like that, it proves they aren't just selling parts. They've built a structure that continuously captures value far beyond, typical manufacturing norms.
Precisely. And that structure is built around 3 crystal clear value drivers that they just relentlessly enforce across their entire organization. They aren't seeking merely satisfactory returns. They're fundamentally structured to achieve what they call private equity-like returns.
So let's elaborate on those drivers because they really are the secret sauce. First is obtaining profitable new business. Second, continually improving the cost structure. And third, providing highly engineered value-added products. But the key that unlocks all 3 of those is proprietary content, isn't it?
It absolutely is. Their success hinges entirely on owning the IP, the blueprints, the certifications for these niche critical components. The sources state clearly that approximately 90% of TDG sales are proprietary.
90%.
These aren't commodity parts. These are components, often small, often highly technical, that are essential for safety, for flight control, engine reliability. And once that part is certified onto a platform, they are often the sole supplier for the life of that platform, which can be 50 years or more.
And that proprietary nature allows them to engage in one of the most powerful business concepts that drives their margins.
Yeah.
Value-based pricing.
VBP. For those listeners who might be familiar with traditional manufacturing, that usually relies on cost plus pricing. You charge what it costs to make the part plus a reasonable markup. TDG just turns that model completely upside down.
That's the absolute linchpin of their profitability.
Yeah.
VBP means they price the part based on the value it delivers to the customer, not just the cost to make it.
Right.
So if their component prevents $1 million operational delay or ensures safety on a flight, the price reflects that massive value delivered, regardless of whether it costs them $50 or, $5,000 to produce. So this practice, combined with a relentless focus on cost structure improvement, that's driver number 2, is what drives their profitability to these anomalous levels.
It creates this massive and ever-increasing spread between their revenue and their costs.
And even with their huge scale, they still see a significant runaway ahead.
They do. Despite being the undisputed leader, their addressed market in the air transport aftermarket is an immense $57 billion annually.
$7 billion.
And get this, TDG currently holds only about a 3% market share of that market.
That's 3%.
It just means the engine of growth, both organic and through acquisitions, is long and clear for decades to come.
Okay, let's put some numbers on that success.
Yeah.
Their FY 2025 performance is It's truly colossal. The scale is almost hard to grasp for a company focused on small, critical components.
The numbers really do speak for themselves.
Okay.
In fiscal year 2025, net sales hit $8.831 billion. But the real measure of their operational efficiency is that profit line. Total EBITDA, as defined, hit $4.760 billion. As we mentioned, that results in an industry-leading, almost unreal 53.9% margin.
A 53.9% margin is not a manufacturing margin. That's software as a service or luxury goods territory. That level of efficiency translates immediately into just immense cash generation.
It generates staggering free cash flow. They produced $2.4 billion in free cash flow in FY 2025 alone.
$2.4 billion.
And that FCF is the fuel they use for their aggressive capital allocation strategy. It funded both the special dividends that investors love and $500 million in stock repurchases during the fiscal year.
And the market expects this momentum to keep going, right? Even with the internal shifts we'll get to later.
Absolutely. The forward guidance reinforces this stability. TDG's FY 2026 guidance is expecting $5.15 billion in EBITDA.
So continued growth.
Continued growth built on the proven model. The operational structure supporting this is also crucial. It's not monolithic. They run a highly decentralized model. They operate over 115 business units, under 50 autonomous operating units.
So that lets local management keep that relentless focus on cost and efficiency without the rigidity that often comes with such a large corporation.
Exactly. It seems like they've managed to scale without sacrificing that private equity-like discipline at the ground level.
We should also briefly touch on the nature of their manufacturing and how they manage financial risk.
On the environmental side, because their operations are largely assembly and light manufacturing, they tend to have low Scope 1 and 2 emissions compared to, say, heavy industry. They have a stated goal of a 50% reduction by 2031, using 2019 as a baseline. But the financial risk management is far more vital here. Given their heavy reliance on debt, a core part of their model, they're acutely sensitive to interest rate fluctuations.
Well, of course.
So they mitigate this actively using derivatives, committing to maintain an allocation of at least 75% fixed rate and 25% variable rate debt.
And that prevents interest expense volatility from disrupting their highly levered operating structure. So we have the undisputed incumbent, huge scale, massive proprietary moat, a 50+% margin, all underpinned by a deep, highly disciplined operational structure. Now let's pivot to the challenger, the Loar Holdings. This is a company that is, it's clearly running the exact same playbook, but at warp speed trying to bridge that gap.
Loar is an extremely intentional attempt to replicate the TDG success story. No question. They recognize the unique profit pools created by monetizing proprietary content in the aftermarket. Their focus is just as clear. Approximately 85% of their sales are proprietary.
A little lower than TDG's 90%, but still very much in the same ballpark.
Exactly. Still firmly within that niche. Their aftermarket sales accounted for 53% of their fiscal year 2024 net sales. And just like TDG, the long life of their served platforms, up to 50 years, ensures that recurring, high-margin revenue stream.
They don't just mimic the proprietary content model, though. They have their own systematized growth blueprint, which they call Loar.
That's their engine for integrating acquisitions and driving organic growth. So Loar stands for launch, optimize, ready, achieve. Launch is about getting new products off the ground. Optimize is the critical piece focused on productivity and cost structure improvement, directly mirroring TDG. Ready is focused on talent. And achieve is about realizing that value pricing and hitting financial targets.
So it's a formalized structure for implementing that private equity-like margin expansion playbook.
That's it.
And their recent performance really shows this Loar RA strategy is firing on all cylinders.
Yeah.
When we look at the Q3 2025 results, this is where the Challenger's growth engine truly shines against TDG scale.
The velocity is startling. Loar reported record Q3 2025 net sales of $126.7 million. The year-over-year growth for that quarter was a phenomenal 22.4%.
22.4%.
And the quality of the growth is essential here. It wasn't just inorganic expansion. Their organic net sales growth for the quarter was still very robust at 11.1%.
Which demonstrates they're simultaneously executing on internal efficiency and external consolidation.
Right.
That 22.4% sales growth is huge. But the real story is how much of that growth is translating into margin expansion. That's the singular metric that will determine if they can actually catch TDG.
Absolutely. Their adjusted EBITDA in Q3 reached $49.1 million, a 28.9% year-over-year increase, More importantly, their adjusted EBITDA margin improved to a record 38.7% in Q3.
Okay, so for the listener comparing numbers, 38.7% is a massive margin in any industrial context, but it still leaves a 15-point gap between them and TDG's 53.9%?
It does, but the trajectory is what matters, the direction of travel.
Let's talk about that net income surge, because it was huge. Net income surged 218.9% to $27.6 million in Q3. Triple-digit net income growth. It demands an explanation. How much of that was structural versus, say, financial engineering or a one-time benefit?
That's a crucial distinction to make. The majority was driven by higher operating income from their sales growth and margin expansion. But there were two significant financial tailwinds that really contributed to that surge. First, they benefited from a reduction in interest expense after the voluntary debt repayment they did post-IPO.
Less debt, less interest. Simple enough.
Right. And second, they benefited from a favorable tax impact from the enactment of the OBBBA tax benefit.
The OBBBA benefit. So for our listeners, that's a specific advantageous tax item that boosted their net income. And while that's great for the quarter, it's essential to understand that this kind of tax benefit is typically a non-recurring item. So that 218.9% surge may not be fully reflective of structural operating growth alone.
Exactly. It's a boost, not necessarily a sustained trend, but it does show strong management of their capital structure. And looking ahead, their momentum suggests continuous margin accretion alongside sales growth. The revised full-year 2025 net sales guidance is for about $491 million.
Okay.
And they're expecting a 38.0% adjusted EBITDA margin. For FY 2026, their initial guidance anticipates $545 million in sales and an improved around 39% adjusted EBITDA margin.
So steady, predictable margin creep alongside that double-digit growth.
That's the plan.
And they are proving their ability to execute the launch part of the Loar strategy, getting new proprietary content into the air.
That's where the long-term value creation really lies. In their defense segment, they've seen improved bookings for ground vehicle products, but the most important operational win recently was achieving 5 PMA brake certifications.
Let's pause on PMA certifications. Why are these so important, and what does PMA even stand for?
PMA stands for Parts Manufacturer Approval. This is critical. Traditionally, the original equipment manufacturer, like a TDG, controls the supply chain for their certified parts.
Right.
When OAR gets a PMA certification, it means the FAA has approved them to manufacture a replacement part for an existing aircraft that was previously only available from the OEM.
Ah, so this is how they organically transition a commodity part into a proprietary high-margin aftermarket revenue stream.
That's exactly it. Securing 5 PMA brake certifications with another 4 in the pipeline demonstrates they can successfully enter markets that were previously, ring-fenced by competitors. This is the organic way they build their own proprietary moat.
That makes perfect sense. So we have the scale giant and the growth accelerator. Now we move into the crucial area of strategic risk, M&A execution, and leadership continuity. This is where the sheer difference in scale and maturity dictates a vastly different risk profile.
For TDG, M&A is constant, but the deals are getting larger and, frankly, more complex. In fiscal 2025, they completed $413 million in acquisitions, including Servotronics for $133 million. But the major transaction the market is digesting right now is the post-fiscal year acquisition of Simmonds Precision, which they bought for a significant $757 million.
And that deal closed in October 2025. Financed entirely by cash on hand, which just demonstrates the power of their free cash flow generation.
It does.
But when a company the size of TDG makes a $757 million acquisition, it's usually celebrated. But this specific deal has an explicit financial consequence they've been very upfront about.
It does, and this is the direct trade-off of TDG's M&A philosophy. Management has explicitly disclosed that the integration of Simmonds Precision is expected to cause 200 basis points of margin dilution to TDG's 2026 guidance.
So why accept a 200 basis point drop from a 53.9% margin? I think the answer lies in their highly unusual M&A philosophy. They're not buying for synergy, are they?
Not at all. They are completely agnostic to conventional M&A drivers. Their philosophy is ruthlessly focused on generating a high-quality, high-return outcome, regardless of the immediate integration pain. They deliberately look away from typical factors like synergy or market share gains or filling out product lines. If it doesn't meet the primary financial hurdle, generating a roughly 20% IRR for shareholders, they walk away.
So they accept the 200 basis points of short-term margin dilution because they know that by applying their operational discipline, that relentless cost-cutting and value-based pricing, they will, as they say, march the margins upward over time until it hits that 20% IRR. They're prioritizing decades of proprietary cash flow over near-term margin optics.
Exactly. It's a high-conviction, long-term strategy that has worked for decades, backed by that phenomenal 36% IRR track record we discussed earlier.
Now, let's pair that M&A strategy with their leadership situation, because TDG has a planned succession at the very top.
Yes, a planned CEO transition with Michael Lisman succeeding Kevin Stein. The key detail here is that Lisman is an internal appointee, deeply embedded in the TDG culture and operating model. Management expects this internal transition to maintain complete strategic continuity.
But is that continuity always a positive? I mean, couldn't an internal promotion risk organizational rigidity? When a company has run the same successful model for 20 years, the lack of an external challenger voice might prevent innovation down the road.
That is the perennial question for highly successful companies, isn't it? For TDG, the internal appointment signals confidence that the model itself, those three value drivers, is the true engine, not the personality at the top.
So the risk is rigidity, as you said. The benefit is eliminating the catastrophic risk of a new CEO throwing out a proven playbook.
They are betting on the system over star power.
Now let's turn to LOA and contrast their M&A pace and leadership structure.
Loar is playing an accelerated consolidation game. They have executed 17 acquisitions since 2012, showing consistent M&A discipline. That includes notable deals like Applied Avionics for over $380 million and Beadlight. And their future target is aggressive. They want to double acquired EBITDA over the next 3 to 5 years. This is how they plan to close that scale and margin gap with TDG.
And they are clearly not shy about pursuing large, transformative deals either, as we saw with their recent agreement.
Correct. They recently entered into an agreement to acquire LMB for a base price of $370 million in Q4 2025. Now, the closing date has been delayed, but the sheer size of that deal demonstrates their intent to execute this high-velocity consolidation. This is the mechanism that generates their 22.4% sales growth.
And their leadership structure provides a sharp contrast to TDG's planned transition.
Very sharp. Loar offers executive stability. Dirkson Charles remains the president, CEO, and executive co-chairman. He is the face of the company and the driver of that Loar strategy. And this stability is critical for a high-growth consolidator.
Why is that?
Because M&A execution relies heavily on management consistency and clear strategic signaling to your targets.
Okay, that naturally leads us into the deepest, most structural difference between the two companies: capital allocation and debt structure. This dictates the primary financial risk profile for both.
This is where TDG is just in a class by itself. TDG maintains a highly leveraged structure. They don't just tolerate debt, they embrace it strategically. They target a very high 5x to 7x net debt to EBITDA ratio.
5 to 7 times.
They view debt as efficient, cheap capital that helps them buy businesses and, more importantly, return cash to shareholders.
And the scale of their cash return strategy in FY 2025 was truly immense.
It was stunning. TDG used $5.0 billion in new debt proceeds during FY 2025, specifically to fund capital return. This funded the stock buybacks we mentioned and, critically, a massive special cash dividend.
Dumb massive.
They declared a stunning $90 per share special cash dividend in August 2025, which totaled over $5.2 billion.
So investors in TDG are buying into this cycle of high leverage, high proprietary margin, and irregular but massive capital return via these special dividends. The debt is high, but the payoff is substantial.
The leverage is the price of admission. However, they have structured their debt intelligently. Despite the massive debt load, their maturity profile is managed. They have no maturity on any tranche of their term loans or notes until August 2028.
That gives them significant operational breathing room to execute acquisitions and integrate them before they have to face refinancing risk.
Correct.
Now, let's look at the mirror image. Loar Holdings. They're running the same operational playbook, but a completely opposite capital allocation strategy.
That's right. Loar's post-IPO focus is explicitly on growth and deleveraging. They used nearly $285 million of the proceeds from their IPO to voluntarily repay term loans, significantly reducing their interest expense.
So that puts their leverage ratio in a totally different category compared to TDG's target of 5 to 7 times EBITDA.
Oh, dramatically different. Their total debt to total capitalization was only 21% as of the end of 2024. Wow.
They are focused on building a stronger, less leveraged balance sheet, which allows them greater flexibility for future acquisitions, but they're not operating nearly as leveraged as TDG is today.
And this focus on growth over immediate returns is reflected in their dividend policy, or lack thereof.
Correct. Loar currently has no plans to pay cash dividends on its common stock. All available capital is being prioritized for growth, for acquisitions, and for continued deleveraging.
So for investors, this is the key difference. TDG rewards you with massive, if irregular, cash payouts, while Loar prioritizes compounding retained earnings internally.
That's the trade-off.
Now, we have to mention the historical context here that gives Loar's management immense credibility in executing this consolidation playbook. The management teams are deeply interlocked.
The leadership interlock context is perhaps the most fascinating piece of insight from the sources. Loar executives, including Dirkson Charles, Glenn D'Alessandro, and Michael Manella. They were previously high-level leaders at a company called McKechnie Aerospace.
And why does that matter? Because TDG subsequently acquired McKechnie in 2010.
So the management team currently running Loar were essentially trained, molded, and then acquired by the very company they are now competing against. They know the TDG playbook inside and out because they helped write it decades ago.
Exactly. This signals profound management competency in executing the exact playbook that TDG perfected. Loar isn't just guessing. Their leadership has direct, successful experience with this highly specialized model.
Before we synthesize the final decision, we have to briefly address the governance risks unique to Loar, especially given its relatively recent IPO.
This is vital for the listener to understand. Loar is classified as a controlled company.
Okay, what does that mean?
This status exists because a specific voting agreement grants Abrams Capital, GPV Loar, Dirkson Charles, and Brett Milgram control over a majority of the voting power.
And what are the practical consequences of being a controlled company for, say, the common shareholder?
It's important because this status qualifies them for exemptions from several standard NYSE corporate governance requirements. For instance, they don't need to have a fully independent nominating committee or adhere to certain rules on executive compensation votes.
So it concentrates power and control internally, prioritizing managerial agility over standard external shareholder protections.
That's a good way to put it. And they also elected to use the extended transition period for compliance under the JOBS Act, which gives them more time to comply with certain public company accounting standards.
So these are structural choices management made to maximize internal control, but they do represent a higher structural governance risk compared to a fully independent public company like TDG.
They do.
Okay, we have defined the strategic territory. We have the $8.8 billion proprietary scale machine that offers special dividends, and we have the $500 million 22.4% growth engine that prioritizes deleveraging. It's time for the final verdict. What is the core investment choice facing the listener here?
The decision really boils down to whether you are willing to pay a premium for proven scale and capital return, or if you're willing to accept the current margin gap for aggressive growth potential and consolidation upside. This is not about choosing a bad company versus a good one. It's about choosing two different risk profiles within the same high-quality niche.
Let's break down the TDG case one last time. Why buy TDG?
You buy TDG because you are confident in the system. You accept the high debt, specifically that 5x to 7x debt to EBITDA target, because it comes bundled with guaranteed quality. You get proven 50% plus margin scale, that 53.9% margin in fiscal 25 and high, albeit irregular capital return via those massive special dividends like the $90 per share payout.
And the primary risk is just maintaining that margin, specifically managing the temporary 200 basis points of dilution from integrating the Simmonds acquisition.
That's the main risk.
And the Loar case. Why take the bet on the challenger?
You buy Loar for the runway. You accept a lower current margin, 38.7% in Q3, expected 39% in 26 cents, in exchange for significant upside potential from that aggressive, rapid growth, their 22.4% Q3 sales growth. You are betting on the management team that learned the playbook at McKechnie to execute the high-velocity consolidation strategy, prioritize deleveraging, and eventually close that 15-point margin gap with TDG.
And you also have to accept that immediate cash returns are off the table, no dividend plans.
Right.
Crucially, both companies are positioned within an industry that has immense built-in secular demand, making the underlying sector fundamentals strong, regardless of your choice.
That's the safety net. Both TDG and Loar are proprietary content providers to the global commercial air fleet. That fleet stood at 28,000 jets in service in 2024. Industry projections anticipate that number will swell to over 50,000 by 2043.
Wow.
The core business is simply monetizing that growing installed base through proprietary aftermarket content for the next 2 decades.
So the choice hinges entirely on scale versus growth acceleration. TDG is the highly efficient, heavily indebted cash machine. Loar is the high-velocity, less leveraged startup running the exact same lucrative playbook.
And the final critical question remains, can Loar execute its consolidation strategy fast enough to reach that coveted 50% margin club before the market fully prices in the massive runway they have ahead of them? You have to decide which blend of leverage, growth, and dividend policy aligns best with your investment goals.
Risk defined. Portfolio protected.